All right, good morning, everyone. Jeff Johnson here, Minnesota Real Estate Journal, and welcome to our webinar, The Impact of COVID-19 on the Apartment Market. All right, so a couple quick announcements before we begin the program. First of all, thank you to our sponsors, SIOR, for helping us out with today's program. Also, a special note to everybody that's watching live on our webinar today. Today's webinar has been approved for 1 hour of real estate continuing education by the Minnesota Commissioner of Commerce. And there's a couple things that we're going to need to do today in order for everybody to get those continuing education hours. Number one, we are going to be time stamping everybody that comes into the webinar today and when they exit today. Also, it's not a bad idea. On the right-hand side of your screen, there is a chat portion. Please take a moment to just type in your name and hit enter. And also, this is going to be a good spot for you to ask any of the presenters questions as well too. Also, there's going to be 2 separate times, random times during this webinar that we are going to be asking questions. And those questions can be answered in the chat portion of the webinar as well too. So the things that you need to do, once again, is timestamp yourself in. Also, put your name on the right-hand side. And then also make sure you answer those questions and then stay until the very end at noon today to get those continuing education hours. And then if you have any questions with regards to continuing education, you can reach out to Katie and her contact information is at the bottom of your screen. All right. One of the other things, important things to make sure you are aware of, if you are having any issues connecting to this webinar, the best mode of transportation is by using Google Chrome. So if you want to copy and paste your URL link into Google Chrome, that is the best way to watch this presentation. Also at the top of your screen, above the green arrow is a red button to hit reconnect. Just reconnect and it'll bring you right back into the room. And if you're watching on a phone or on some other iPad device, it'll be at the bottom of your screen. All right, and as mentioned before, we do have a chat component that you can be asking any of these speakers questions on the right-hand side. And then if you're on your phone, it will be below the screen. All right, and we do have a YouTube channel where we've actually produced about 30 similar webinars over the last month and a half. Please check out rejournals.com/video replay. All right, this is the impact. Now we are going to begin the impact of COVID-19 on the apartment market in Minnesota webinar. So let's start off by introducing our panelist. So we got Keith Collins. Keith is Executive Vice President of CBRE. We have Chris Sherman, Senior Vice President of Operations and Capital Markets, Sherman and Associates. Ted Bickle, Senior Vice President, Colliers International. And finally, we have Brent Rogers, owner, Saturday Properties. So I'm going to turn it over to the speakers, and they're going to make this as a roundtable discussion. So I'm going to actually pop off the screen, and you won't hear me until I pop in here in about 20, 30 minutes for the first CE question. Gentlemen, it's all yours. Take it away.
All right, well, I'll kick it off. Keith Collins here, CBRE. Again, I've been at CB since '96 in the industry for the early '90s, and until this COVID, quite active in the apartment brokerage business. Unfortunately, our brokerage business came to kind of a standstill. Year to date, we've traded $400 million has traded in our market. Typically, our market the past few years, we would be trading like $2 billion. So it's certainly going to be on slow pace. And I think us brokers, Ted Bickle, we've been kind of working on just gathering data for our clients, really focus on collections. What does that mean, et cetera. And again, I think, Chris and Brent will chime in a little bit what those are like. But again, I think, the deals we were working on, we had 6 deals going into COVID, 2 got done. I think one of the drivers for deals getting done, we still had 1031 money that was out there, although that extension has been extended out to July 15th. We had a couple deals that blew up because of just the uncertainty in the marketplace. In addition, the lenders are requiring these additional reserves, so that's creating certainly more uncertainty and making these deals harder to pencil. We still have a couple deals in the pipeline, but reality is we had 250 million of product that we were going to bring out from April 1st to mid-May. All that's been put on hold. So we're hoping that maybe with the collection trend, and again, I think you'll hear from Chris and Brent, the collection trend for May is actually in some cases better than April. And so I think maybe that'll give some confidence that maybe that we'll see some more sellers out there. But the reality is, I think you'll see there's a disconnect right now. Sellers are kind of with the mindset, I think I want to get through this. Again, operations are going to be choppy, but we get through this. And on the other end, there's a good chance that interest rates may be lower. So right now, let's not panic. Let's hang in there. And then the buyer mentality right now is, with all this uncertainty, how do you underwrite? You got to underwrite very conservatively. And generally speaking, they're discounting certainly more than I think the sellers are willing to sell right now. So that's kind of a little update to kick it off from me.
Yeah, on our side, Colliers, we've had the same experience. I'd say the hit rate on anything that was pre-COVID in terms of being on the market or under contract, maybe 1 out of 4, 1 out of 3 deals got done or is getting done. The remainder were either shelved or delayed out to hopefully later this year. But we really noticed too, when there was a large amount of uncertainty in mid-March to late March, there was really no conversation to be had between buyers and sellers in most circumstances. I think most of the buyers either paused wholesale with really no intent on closing on transactions for the time being, or they were opportunistic in nature and looking for discounts. And we not necessarily in the Minneapolis market, but we still hear buyers are looking for 5 to 10% price reductions across the board due to the economic uncertainty. And I think a lot of that too has to do with where the owners are coming from. I mean, you can gauge on the broker side pretty quickly if a deal has a chance to get done in this environment, just based on what the response is like from both sides of the transaction. I mean, I think a lot of the sellers are looking at it in terms of months and thinking that if we can get through collections in April, May, June, maybe through the summer, we're going to be back in the same type of price setting and aggressiveness on the buyer side by third or fourth quarter of this year. And on the buyer side, I think that some of them are looking at this years out, and like Keith mentioned, aggressively modifying their underwriting requirements, and underwriting no rent growth or negative rent growth, which has a huge impact on pricing. So we can go more into cap rates, but I think instead of looking at it in terms of a cap rate adjustment or just a wholesale price adjustment, it really has to do with tapering back some of the expectations that buyers had on underwriting out the first couple of years.
Good morning, everyone. You've got Chris Sherman here with Sherman Associates. Great to see you all virtually this morning. Sherman Associates is a developer, owner, operator of mixed use, mixed income, primarily multifamily housing around the Midwest. We're based here in Minneapolis. Minnesota has been our backyard for 40 years. A lot of what we do is affordable housing, but we, over the last 10 years, have done a lot of market rate housing as well. So today I'll speak on both, on development and operations. As noted, with specifically how we've responded to COVID-19. I mean, it's since March 16th really been a sprint here the last 2 months to shift how we operate, shift the way we serve our customers, shift the way we serve our team members, and really maintaining a primary focus on safety and the perception of safety. So we have made a lot of changes in how we operate. A lot of those are short-term, But I think what's great with what our industry is doing, what our peers are doing, is we're coming together, and some of the changes we're making from a technology standpoint are going to last for the long term. And we'll touch on some of those today. From a collection standpoint, as we looked at April and May, we actually saw an increase in our collections for both our market rate portfolio and our affordable portfolio here in May, when looking at May 6th compared to April 6th. As of May 6th, we're 91.06% collected. As of the same day in April, we were 90.53% collected. So and that's a mixed blend of our affordable and our market rate. Our market rate is 96.94 as of today, and it was 96.39 as of the same time last month. So collections have been strong. We've been working on deferred payment plans with residents that are experiencing hardships. About half of our uncollected rent for April is documented through deferred payment plans. We're working collaboratively. Our goal, and I think the industry's goal through this, is to really minimize evictions once eviction moratoriums are lifted. From a development standpoint, we'll touch on this more, but I mean, we are shifting our development priorities. There's certainly some challenges that we have experienced with our developments, both prior to COVID-19, but also during COVID-19, and we'll talk about those more here as we progress forward. I'll pass it off to Brent.
Brent, we can't hear you.
Brent, turn on your mic on the top of your computer again. The blue button. Can you hear us, Brent?
We can't hear you.
We can't hear you. Sorry. Well, why don't, as Brent kind of works on his audio there, Brent, at the top of your video monitor, there's a button up there, on the far left-hand side.
Jeff,
don't push the yellow button. Yeah, go ahead, Keith.
Well, I'll just continue with Chris until Brent. That's what you get, Brent. That's what you get for trying to do that outside. But Chris, what do you think the reasons why May collections are, quite frankly, on par with April, or it sounds like in some incidents that for you and other companies I've talked to, they're even better than April.
Hey, Brent, do you want to log out and log back in? Then close your browser and then come back in. Go ahead, Keith and Ted and Chris.
So to answer your question, Keith, I think back at the beginning of April, there certainly was a lot of uncertainty. The stimulus bills were being passed, but there was uncertainty in timing of whether it was receipt of the stimulus checks or receipt of unemployment checks. Both of those things did occur in April, and the stimulus checks coming in, I think, gave our customers, everyone's customers, additional confidence that there was going to be a source to pay rent in the near future. I think we expect similar collection levels for June, July, August as well. But at the beginning of April, that certainty, that feeling of any comfort really wasn't there. So one of the reasons we probably saw lower collections in April was there was that level of uncertainty. And by May 1st, there was a bit more comfort that there were going to be those income streams coming into our households, specifically low-income households and workforce households that have been hit the hardest. So those stimulus checks getting out to everyone in the second half of April made a big difference. And that was one of the things we watched very closely. We knew if those stimulus checks did not make it to a majority of our households by May 1st, that we would see far less collections than what we've seen. So that's really, I think, the driving factor for why we've seen an increase in collections. It's the stimulus funds and the unemployment benefits that have been boosted, making its way to our households.
And what is your outlook for the summer months? June, July, and August. Well, how would that? I mean, given what you saw in May and with what you just articulated here, does it feel like the summer months are going to be okay for collections as well?
We do feel like June and July and likely August will be at similar levels to April and May. in large part because the unemployment boost is there for 4 months total, and likely will be extended longer. There may potentially be another stimulus bill passed with direct payments out to our customers. But I think we've got good confidence considering the unemployment boost that's currently available that we'll see similar collection levels, 91, 92 for affordable and 99.5% is what we saw for market rate in April. I think we'll see similar collection levels for June, July, and August. We'll also, I think, as a result of this, see collections potentially go up a bit more in June. I think we'll actually see higher collections in June than we do May, just as we continue to modify our communication to our customers regarding the various options they have available. But come September, October, there's certainly a bit more uncertainty with where we'll land at this point.
Chris, do you foresee?
You still can't hear Brent, but go ahead.
Chris, do you foresee payment plans stretching out all the way to the fall, or how are you handling that right now? Is that a small minority of tenants, or?
So in April, we had 136 households sign deferred payment plans, which represents 2% of our portfolio. And as I mentioned, we were 96.5% collected for April. So of the 3.5% that was uncollected for April, 2% of that 3.5, or more than 50% of it, was deferred payment plans. And our standard deferred payment plan is paying half now and then half the following month, but we're being flexible. We've had households come back to us as part of that initial batch of 136 and ask for another month. It's our objective here to minimize evictions. Right now, there's eviction moratoriums for HUD-insured properties, which is the bulk of our portfolio. But there's also eviction moratoriums for certain markets that we're in. And I think I speak for most operators out there, or all operators that are kind of our peers. Our objective as a whole is to minimize the number of evictions coming through this and out of this. And I think that's always the case, but we're going to do whatever we can to serve our customers experiencing hardships. And there certainly are a lot of our customers experiencing hardships. But as I mentioned, the deferred payment plans that were requested only represented 2% of our portfolio. So most of our customers are receiving the revenue streams they need to pay their rent right now.
All right, so let me interrupt here for the first CE question of for today. So the first CE question here for today is, what percent of tenants and renters do you believe will be paying their June rent on time? Please reply in the chat box. All right.
All right, I'm not sure if we've got Brent
back. You can go ahead again.
Right. Chris, maybe you elaborate on what are you doing? What is your company doing to address the COVID? I mean, again, your amenities are shut down. Just what steps with maintenance? I think audience would be interested to see what protocols companies like yourself have put in place.
Absolutely. From a property management perspective, we have changed dramatically the last 8 weeks now, or 7 weeks. From a leasing and management standpoint, we've gone virtual. Our interactions with our customers are 99% of the time done virtually, over video, over the phone, over email. With maintenance, that's much more still physical on site, but with very limited interaction. We're not doing our standard reoccurring work orders. We're only doing emergency work orders at this time. I think that's very consistent with what you're seeing across the industry. We're providing our team members with the protection gear, face masks, hand sanitizer. We've partnered with a local distillery, a whiskey distillery here in St. Louis Park, to produce hand sanitizer for us. We've thus far gone through about 300 gallons of it across the Twin Cities. So we've been distributing hand sanitizer out there, but it's been a major shift of how we operate, how we interact with our customers. I think, as I mentioned earlier, some of the things that we're doing right now will last much longer than COVID-19. I think some of the virtual leasing initiatives that we've rolled out along with the rest of the industry will continue to be something our customers, our future customers and prospects will look to as they move forward. Maintenance, I mean, our certainly our concern with maintenance right now is what's occurring in the units that we don't know about. One of the big things we've been very focused on is communication to our communities, over communicating, whether it be regarding the amenities being shut down. They have been shut down since March 16th. We are looking to reopen them. That could be on new policy. We're rolling out a lot of new policy. It could be on rent collections. It could be on the stimulus checks that were sent out. But the big one that we're communicating on right now is what's going on in your unit. I mean, we need to understand what's going on in the unit, what work orders haven't been submitted. Because once we start to go back in the units to do standard routine maintenance, we want to be able to go in there and make sure the unit's in great shape. That there's not something that's lingering that's going to cause a more substantial impact to the units and to their experience long term. So that's information that we're proactively collecting, because right now our concern, and I think the industry's concern, is what residents aren't submitting work orders because they know those work orders are not going to get completed right now. So we're trying to proactively and efficiently allow our customers to submit those work orders and give them feedback saying, I mean, we'll come in to do these things, but there's other things certainly that we're not going to come in to do for the near future. Hopefully in the next month or so, we're able to get back into the units and start to do more of the standard routine maintenance, but it could be longer.
Do you think?
Can you hear me now?
Surgeries?
Yes, we can.
Yeah, we can hear you.
Brent's
I was
on.
going to
Okay.
ask the question too, Chris. Do you think that much like they talk about the fact that people aren't going to hospitals for quote, elective surgeries, do you think that there are tenants that are not submitting work orders for serious issues because they don't want someone to enter their unit, or is that not really a concern?
That is a concern, and we are noting provisions within the lease that requires them to notify us of serious concerns. So I think in large part people are communicating to us regarding serious life safety concerns, whether that be heating, cooling, water. Those are things that we're going to go in and address immediately. But that is an ongoing concern, which is why we're over communicating and pointing to the lease and just letting residents know we're here to assist them in any way we can. But certainly that is a concern, Ted.
Hey guys, sorry about the audio. Saturday, please. We are an owner, operator, developer, and manager of about 2,000 units, mostly market rate. About 90% of our portfolio is market rate. About 2% is affordable. Fair amount of mixed use, and for the most part, it's newer properties. The oldest project we manage right now is about 10 years old. The average age of our portfolio is 3 to 4 years old. I think our numbers on delinquency are very similar to what Chris mentioned, although we flipped a sixth collected about 90.5% of rent. Back in April, it was about 91.5%. And then we finished April collecting about 94.5%. So just over 5% delinquency rate, which is about double what it was year over year. April 2019 was about a 2.5% delinquency rate. So we definitely higher, but not to the real level of concern that that people have been looking at. I would say, our concern probably lies looking down the road at our 30, 60, and 90-day trends, and we're just starting our busy leasing season, and intentionally have those lease expiration curves expiring in the May, June, July, August timeframe. So we've got a lot of apartments that are coming up for renewal. Some of the bright side of this is that renewal rates are up. Based on our math for the first 4 months of the year, renewal rates are up about 20% from where they were the year prior. But it's still, we have a lot of exposure in the portfolio and new leases that need to be had over the next few months. So that's, a big focus of ours is shifting our business to this, whatever this new normal is, with whether it's virtual tours that we've been conducting over the last month, and we're now moving into actually contactless tours, which allow the prospects to get into the building and see their potential apartment, but without direct contact with building staff and leasing agents. So we've been putting work on that over the weeks and actually rolled that out this week, and we're seeing some success with contactless tours. And then another big focus of ours is how do we safely start reopening amenities and common areas in the buildings. Obviously, folks that have been pent up for 2 months in 400, 500, 600 square foot apartments are very anxious to get out and start using fitness centers and the other common areas of the building. So we're putting a plan together once the shelter in place orders are lifted to be able to slowly start reopening those amenities. Obviously, with an eye on primary focus on safety of both residents and staff, but we're putting plans together so that we can start slowly reopening those amenities.
Hey Brent, what are you? You mentioned about 20% renewal increase. What are you doing for new leases? I'm hearing obviously concessions are spiking up. What are you doing for new leases, and what are you doing for renewal rates?
Right. It's case by case, depending on where those rents lie, the existing rents compared to where we think market is today. But generally, if we would in a typical year be looking at somewhere 2.5% to 3.5% increase on in-place rents, we're generally approaching our renewals without a flat or no increase, just to try and maintain as many folks in those apartments as possible.
And then for new rents, is it? I'm kind of hearing, maybe concessions have increased maybe a half month. Does that sound right, or not?
Again, I would say some submarkets are impacted more than others, but I would say that's probably in the ballpark.
And then what about traffic? How does your traffic look, right now compared to like maybe a year ago?
Sure. I would say, somewhat shockingly in late March and early April that we were still, getting traffic and leasing apartments. It just, goes to show that I think apartments are a nice stable asset class, even in a pandemic like this. But, for looking at the month of April overall, our traffic was down about 40%. And we did in same store sales, we did half as many leases in April 2020 as we did in April 2019. So it's definitely impacted.
We've seen a similar impact with our leasing. On the flip side, we've seen the increase in renewal rate. So it obviously works hand in hand. If we have higher rates of renewals and fewer people moving out of our properties and moving into new properties, the leasing is going to slow, and that's certainly what we've seen. We are leasing up a couple properties right now in Minneapolis and Coon Rapids and Westminster, Colorado. Our Coon Rapids property has been leasing up faster than projected. I think that is a result of it offering a new product at an affordable price point right now. Our other two lease ups have slowed down a little bit, but continue to move forward towards leasing up on schedule at the underwritten rents with minimal concessions. We're not having to offer any boost to our concessions yet, but certainly that's something we're watching closely across the market, and we have seen a little uptick in concessions during this period, in large part, I think, to incentivize that move during this period where people don't want to move as much. And we are seeing, as I mentioned, higher retention, higher renewals, specifically as a result of people not wanting to move during COVID-19 as frequently.
And do you guys see, for both of you, on the lease-up side, the demand levers probably have not changed, or I would assume they have not. Do you see changes in the lease up schedule that comes out this, say for a delivery this summer? It was going to be 18 months. You see it being 24 months, or how is that affected?
I mean, we typically would underwrite our lease ups to be 9 to 12 months. I think to your point, we would expect from an underwriting standpoint to be required to, and we would want to underwrite a lease up schedule that's maybe a month or two longer. I wouldn't say it needs to be 4 to 6 months longer, but I do think a couple months longer due to the next few months at least having projected slower leasing. But come next spring, next summer, I think leasing will be back to normal rates. And then I think 2 years from now, 3 years from now, leasing will be accelerating beyond what we would have projected because there's going to be less new product coming online in 2 to 3 years because of what's going on today. But no, we right now as we underwrite deals are probably flipping a 9-month lease-up schedule to a 12-month lease-up schedule.
Chris, you manage other properties in other states. You know, any just commentary on just how Minneapolis compares to other markets? You know, for example, you know, we've been on these national calls, you know, CB, and generally speaking, the Midwest markets are holding up better than throughout the country for the most part. Our collection rates are certainly higher than a lot of other parts of the country. Minneapolis is certainly probably the best market in the Midwest, I think, because of our diversity. And a lot of people, historically, rent, pretty much are, I think, on average, about 20% of our incomes would go towards rents. So again, it gives us a lot of ability. Our incomes are higher. So residents, certainly have the ability and to withstand kind of these challenging times. So any commentary just on Minneapolis, how it compares to your other markets?
Absolutely. We are in the Twin Cities, Des Moines, Milwaukee, and Denver. And we've seen, as you noted, higher collection rates than I think the balance of the country, in part because we have more affordability in these markets than other areas of the country, and in part because our healthcare system, I think, has held up very well through this period. The stimulus funds and the unemployment funds have really helped people continue to make their payments. I also credit the industry. Our counterparts that are managing multifamily across the Twin Cities and in Des Moines, where we saw really strong collections as well. We did not see as strong of collections out in Milwaukee. Our collection rate in Milwaukee was about 5% behind the collection rate here in Minneapolis. But I think the communication that's going out from the industry here in the Twin Cities to our customers is very strong regarding our renter obligations, but also regarding the stimulus funds and other benefits and just timing of when they would receive that. If they haven't received it, this is what you can do. I think we're being extremely proactive as a whole here to work together to communicate out to our customers, and that's in turn helping them make the right choice for them. Some are choosing to enter into a deferred payment plan because they're experiencing hardship, but as noted by both me and Brent, and I think the industry, I mean, 96-97% of residents are in a position to pay their rent, and I think they have confidence to do that because of some of the strong communication coming out from the private side and the public side as well from the state regarding kind of what the future holds.
Brent, I got a question for you on the amenity side. Since you're managing mostly newer market rate product, do you see tenants pushing back on paying for amenities that either can't be used or are underutilized?
I'd say yes. Not across the board, but I would say earlier in this process, we definitely heard some griping about just that they'd like to see discounts because they weren't able to use those spaces. Chris can talk a little bit about what they did across the board. We work with a variety of different owners, so it's really it was individually as to whether and to what extent discounts were offered to to residents because of those amenities. Definitely definitely heard from residents that were frustrated at that.
And I can speak to what we did across the board. So as a result of our amenity spaces being shut down as a result of us not doing standard routine maintenance during this period, as a result of us, because of these things, reducing certain operating expenses, we increased in other areas. We felt that it was appropriate for our portfolio to incentivize timely payment and also provide our customers with the feeling that by having those amenity spaces shut down, they're getting the deal they, from a business standpoint, that they thought they were going to get. From a legal lease standpoint, the amenity spaces aren't included. But we did provide a 5% discount for timely rent payment in April and May. We are rolling out reopening our amenities over the next few weeks with rules in place. As the stay-at-home gets lifted, we do envision reopening a lot of our amenity spaces with rules, with social distancing rules, with limited capacity by the end of this month. And really, I believe that April and May will be the 2 months where we provided a 5% discount for timely payment. If residents did not pay their rent by the 5th, then it flipped back to the full rent amount being due. And that, I think, in turn did help us achieve higher rent collections early on in the months, and overall higher rent collections for the total month. As I mentioned, we had about 96.5% rent collections in April. I think we'll be at 97% for May based on where we're trending today. But that's in part due to that discount we provided.
Okay. Well, Keith, I saw a question on the return for sales volume and where pricing will pan out later this year. Do you want to touch on that?
Yeah, I mean, yeah. Well, unfortunately, I think it's not good news for you and I. I think the reality is we need consumer confidence, to come back, and until we truly get like a vaccine or antiviral that it really instills a ton of confidence. It's just it's hard. It's going to be hard for deals to probably get done. One, because there's a lot of money out there. I think the one thing that's maybe different than it was back in 08, 09 is there's a lot of equity out there that wants to go somewhere. And apartments market rate's going to be good, but the challenge is they're raising money for more of this distressed, and is the distress really going to be there? I'm just not seeing the distress, especially in Minneapolis, anytime soon. And so the question is then, are sellers, are they going to want to get out and take a little bit of a haircut, or just wait until we get through this and think their values are going to go up like some people have articulated before? I think sale volume is going to be slow the next couple quarters. We could see maybe an uptick towards the end as the confidence comes back, but I think it's probably going to be slow this year. And but I do think once we have that, some strong confidence, I think it really could come back strong. But right now it's going to be slow. And I don't know, Ted, if you want to comment on values, where we think they are right now, I can opine too. Yeah,
well, I think that the sentiment that you're going to get just an across the board price adjustment has fallen away, at least in the Twin Cities. Because I don't think a lot of deals got done. I mean, we had a couple where there's minor price adjustments, but it'll go more towards that item that if buyers are being realistic and underwriting lower or slower rent growth going forward, that has a significant impact on pricing. And it's just more a matter of, does that change to what you said? Is there more confidence going forward that the recovery will happen faster, and that will revert back to where we were in terms of market conditions sooner? But I think the other thing too is just a practical point, which is different versus other types of recessions. I mean, in talking to clients, people don't want to or can't travel right now. So even if you were to bring a deal out, I think it's going to be difficult to get traction with doing tours and having people really dig into it, apart from looking at the financials, because there's just the general idea right now is that people are not going out and traveling if they're not locally based.
Yeah, I agree, and obviously we're doing the same thing that the leasing managers are doing. We're having, for offering memorandums, we have to provide virtual tour options. So acquisition guys can they can tour a property, from afar. But at the same time, we've heard from a lot of these investors, it's still going to be hard for them to go to IC committee and to get approval if they haven't seen the deal. And so, again, I think we're finding ways to get third parties done, but it's challenging. And it's just, again, uncertainty. It's hard to transact in uncertain times. And the certainly, I think as we get that more confidence, less, uncertainty in the marketplace, the sale volume will pick up in that. So.
Well, and I wonder too if we'll see less new capital coming into the market for the time being, given that the groups that are already here, whether they're locally based or not, have the ability to do those tours and diligence reports locally, and they have some familiarity with the market, so there's probably not as much uncertainty. Whereas a group, groups that have been looking in the Twin Cities or are looking here for the first time just won't have that same ability.
Well, the other thing good for Minneapolis is, as I mentioned earlier, I think our collections rate was one of the, I think in April we were like ranked number 4 in the country. And so what the good thing on that is, investors are going to look at Minneapolis, if they're getting, hit, again, their exposure certainly is less than these other markets, and then we should be coming out of this better than other markets as well. And so I think that's going to really help. As I mentioned earlier, I think there is a lot of equity out there. There's a lot of capital, and I think that capital is going to come back to Minneapolis probably, quicker than other markets.
Mm-hmm.
I don't know, Chris, or if you have any thoughts on that with your other markets.
Yeah, I think Minneapolis, the Midwest, presents a lot of long-term upside to us, and then in turn, I think to buyers. We're in a very affordable market here in the Twin Cities compared to other major markets around the country. I think our park system, our space certainly is playing very well during this period to have enough outdoor space across our downtown core to utilize. I think has made the experience living here during this period far better than maybe New York or San Francisco or Chicago. So I do think that multifamily housing, as more people spend more time working from home, as people travel a bit less, I think multifamily here in the Twin Cities will continue to do very well long term. And I think we'll find ways through this to allow our housing long term to continue to be affordable through technology improvements, through better service, more retention. I think there's many things we can do to continue to maintain a very affordable housing inventory here in the Twin Cities compared to some of our other peers across the country, which I think then in turn just makes it more attractive to buyers, continues to make it very attractive to buyers. But we did sell one property in late March. And I mean, we are, I think, still confident that there's buyers out there looking at the Twin Cities. But certainly there's fewer today, but they'll come back for the reasons outlined.
All right, so I'm going to interrupt right here for our final CE question of the day. Please, once again, put your response in the chat component of this webinar, and then also a reminder that you do need to stay on until the webinar is completed at 11 a.m. in order to get those continuing education credit hours. So, a lot of new apartment buildings have a lot of awesome amenities. Chris, you were talking about that you're slow to open up some of these. When does everybody think that all these apartment amenities are going to be in full use for everybody? How long is it going to be? Is it going to be a month? Is it going to be 6 months, a year, 2 years? How long is it going to take?
To get to full use, I think it's going to be a staggered period where we're working our way back up to 100% occupancy. As we look to reopen our fitness centers and reopen certain amenity spaces like our rooftop patios here in late May, assuming the stay at home is lifted May 18th, we're looking really at two things. One, retail right now is opening back up to 25% occupancy. And there's a little echo coming through now. I don't know what happened. There it goes. Okay, thank you. And then we're looking to grocery stores, and we're looking to our Starbucks stores on maintaining social distancing rules, stickers or whatever is being used at grocery stores. I mean, we're going to recommend in our fitness centers that people are 6 feet plus apart, which means ultimately that original occupancy we had up for the fitness center or for the community room won't be able to be as high as it was. And we'll set an occupancy threshold likely initially here at 25% for those areas. And for our fitness centers, we'll likely restrict guests. We're still having conversations on whether we provide that same restriction for community rooms. But certainly for our fitness centers, it will just be for residents for the next probably few months at least. It'll be a staggered period. A year from now, our usage of our amenity spaces will be different than it was. That new normal will be a bit different. I think it'll take a year to get back to the new normal for our amenity spaces. And in between, we'll take a lot of steps to make these amenities very appealing for our customers, but put the rules in place that give them comfort to use those amenity spaces and give our team comfort that they're being used consistently with what other industries, whether that's, we're going to look to fitness chains and what they're doing and how they're reopening. We're going to look to entertainment centers and how they're reopening, and we'll kind of look at our community rooms as they are applicable to entertainment centers. So we'll be looking at a lot of different industries as we progress forward and really locking arms with our peers. And that's the big thing. We've been having peer-to-peer calls here in the Twin Cities down in Des Moines with all of our industry peers and hearing on a weekly basis what they're doing. And I think we want to really align ourselves and provide the best service possible to our customers, and open up our amenity spaces as soon as people are comfortable with them opening. I mean, the sooner the better, but we have a lot of steps that we'll take to get back to the full reopening of them.
Chris, maybe you can comment a little bit just on the development pipeline. Obviously, you mentioned it's going to slow down, but how are you looking at development deals right now as far as just underwriting deals? Obviously, I know you're not completely shut down, but maybe just speak to how that math looks today for new development deals in Minneapolis.
So is my audio back on?
It is.
Yep. Okay. Hey, all right. Go ahead, Chris.
So we've generally shifted everything in our pipeline back 60 days. We've shifted some projects back further than that. But we've also accelerated a couple projects up that were potentially going to be 2021 closings. We're now making them fall of 2020 projected closings. Our next closings in St. Paul, end of June, early July, we're closing on 173 units of market rate housing and 86 units of affordable housing. As we look forward, we're certainly over the next 2 years projecting little revenue growth, but then an acceleration of revenue growth in 2022, 2023 to get us back to kind of what we've been projecting prior to this. But over the next 2 years, as I noted earlier, it will likely be a slightly slower lease up, and rents will plateau here for the next 18 to 24 months and potentially go down a little bit. But the other two factors that we're tracking, and I'll say this, one of the reasons that our developments right now we're not financially feasible, one of the big reasons wasn't COVID-19. It was real estate taxes and construction pricing. Real estate taxes have gone up a lot here the last couple of years. Construction pricing has as well. We'll see where construction pricing goes over the next 6 to 9 months, but I would bet to say it's going to plateau or come down a little bit, which will make these projects a bit more financially viable. The other tool that we're utilizing, both in development and to refinance a big chunk of our portfolio right now, is historically low interest rates. And that's going to help make some of these projects viable. Rates right now are approaching historic lows, and they're projected to go lower over the next few months. So that's a tool that we utilize for our developments significantly. We're doing a lot of affordable housing, and a lot of that's financed by debt and tax credit equity. And then with our market rate deals, we're utilizing tax increment financing on some of them. So having low cost debt available at our fingertips is critical for making these deals financially viable, and it's long-term debt. We're accessing some long-term debt. Certainly the pool of debt options has decreased a bit over the last few months, but I think we've got a really strong network of relationship lenders here in the Twin Cities that are allowing good projects in good locations that have really great long-term potential to continue to move forward. But certainly we're being very cautious with our pipeline, and we do have a couple projects under construction. They are experiencing some minor delays. I would say anywhere from 3 to 5 weeks on a 16-month build as a result of this. So that is a big consideration for why we push back our timing of some of our closings by at least 60 days. And then also just city approvals. Cities are focused where they should be. Lenders are focused where they should be. Cities are focused on COVID-19. Lenders are focused on SBA PPP applications for small business that really needs that. We can hold off on our multifamily housing development for a few months and be fine, but a small business, a restaurant that's failing right now, they need those funds, and all of our banks are prioritizing that as they should be.
You think, labor costs coming down on the construction side, hard costs? Then the other thing I saw, with our projected $1.5 billion surplus is now a $2.4 billion negative. So the question, a deficit. The question is, how do real estate taxes look for apartment owners, going into the balance of the year and next year?
Well, they went up a lot this year in Hennepin County and Ramsey County. So hopefully they don't go up at all next year. And I think, we're appealing a number, and that would have occurred regardless of this. But certainly as we see revenues plateau, what I will say is with our multifamily portfolio, we don't project much of a drop in NOI, if any. Revenues will plateau, but our expenses are quickly plateauing as well, if not decreasing, as a result of some of the things I noted. And there's a number of whether it's turnover expense or bringing a few more things back in house during this period, as we don't have to do as much on the amenity service side. There's a lot of things we're doing to reduce our expenses, and the cost of our debt's gone down. But NOI, I don't project to go down a lot during 2020. But real estate taxes continue to have a big impact on financial viability of producing housing, preserving affordable housing is a big one, a big subject right now. But producing housing in general, real estate taxes, the increases the last couple of years have made a lot of projects that were viable 2 years ago no longer viable. And I think the combination of COVID-19 and real estate taxes is certainly right now pushing back a lot of start dates.
Yeah, I can piggyback on Chris's development discussion. We've had a front seat as we have a project in Minneapolis that's a second phase of a project that opened about a year and a half ago and is full and stabilized. But that we had planned to close that project in the second quarter of this year. Went in for a permit this spring and had 2 lenders that we have existing business with that were approaching the finish line on the project, and we heard from the lead lender that they were pulling back on new development to see how things were going to shake out. And so we pivoted and said, well, we'd still like to keep moving forward, and we think it's that late next year is going to be a good time to open a new building, because there's going to be less new product out there. And because of banking and lending relationships, that deal has moved forward, and we do anticipate closing next month. So I think and just what we've seen anecdotally is that lenders are they're asking for more longer and more interest reserves to factor in a longer potential lease up, which I think helps everybody and makes the deal more secure, assuming you can fit it into the source and use of funds. And then secondly, that lenders are retrenching to to their known customers and the relationships that have been proven, and not as willing to take risk on whether it be new relationships or less experienced developers.
Well, Keith, I got a question for you. I wonder too if the investment sales side slows considerably for the rest of the year. Do you see any uptick in equity chasing new development deals, given that instead of underwriting to own something in 3 months, it'd be 18 months from now, which perceivably this whole thing would have blown over?
Well, the one thing I think we are, again, I think it seems like the most concerned areas right now, I think, would probably be kind of the lease up deals, and then probably the C deals. And although I know Chris said he's not seen as much, but I'm hearing from a lot of their owners, the C product is most, people with check to check and maybe not the subsidy. So, but I think land opportunities that maybe that aren't making, I think you're going to see, an opportunity for the right land deals. And so I do think you're going to see an interest, maybe pick up for people trying to, quite frankly, finding good land sites right now, knowing that when we get through this, and it takes a while, as we know, to build these things, there may be an opportunity there. That's kind of my thoughts, Ted.
And especially if, like Chris said, construction costs come down 5% or whatnot. I mean, that makes the deal pencil all much better versus pre-COVID numbers.
Well, the other thing we talk about the debt, again, I think Chris mentioned it, Brent as well. Even though the lenders are requiring more reserves, which makes sense, we understand it for collections, et cetera, for longer lease ups. The rates are still. I just talked to Joel Torberg in our office this morning, and I mean, again, I think 10-year money, we're in the low 3% with reserves. In addition, I think Freddie just lowered their floor to 50 basis points. Spreads went down like 20 basis points yesterday. So you'll see the agencies, Fannie and Freddie, while they were trying to maybe slow down their volume a month ago, are going to want to try to provide more liquidity in the marketplace. And I think that's just going to help out owners, developers, et cetera, going forward.
Keith, do you know what that means for proceeds? I mean, obviously, lower rates are great for debt service coverage and and cash flow. But how is that going to? Do you think that that loan to values are in terms of how agencies are looking at things, that loan to value
conservatively?
Yeah.
No, I think that's right now they're being conservative on LTVs again, but as they're trying to provide more liquidity in the marketplace, if they have to change that, right now they're being very conservative on that, and it's hard because you have to write a big check for equity plus reserves right now, and unfortunately this reserve requirement's kind of like dead money too. Investors are like, well, I may get it back in a year, 3 years, but it's like dead money until you get it back.
I have a question for Brent and Chris. Do you guys think that there are positive silver linings to this situation, and that there are certain things that you're doing operationally now or designing into developments that you would have not thought of before, whether that's virtual tours, lack of on-site entry? I mean, I think just like the no-touch policy, is any of that going to sustain past the pandemic?
Yeah, I think two things for us. One, I think we'd like to think of ourselves as as an early adopter and tech forward. We're a pretty small company, so we can be nimble. But this has definitely lit a fire under adopting new technologies. I think 3 months ago we were not proponents of self-guided tours because we felt like that interaction with our sales team was critically important. Well, now we're, figuring out that we kind of have to do that with social distancing, and but we're also very focused on how do we provide the same level of experience for both residents and prospects without that direct touch. So it's definitely fast forwarding the implementation of technology, and then I think it's also just making all of us take a real hard look at operating expenses and how to best staff these buildings going forward. I think it's maybe accelerated some of the trends that were already underway.
Mm-hmm. I agree. I mean, I think this is going to help accelerate, improve service to our customers from a technology standpoint, growing percentage of the customers as a result of this, but also prior to this, wanted the virtual experience. But the other thing I think it's going to shift for us as we're building new projects is the type of spaces we provide, the unit mix, assuming more people are working from home. Do we have the shared workspaces, or do we do more 1+ dens or 2+ dens? I mean, those are going to be, I think, things that are going to be in bigger demand here for the foreseeable future, as more companies, more businesses allow more flexible work from home policies. So we are looking into that, as well as we're looking to close several developments over the next 12 months. How do we potentially consider shifting some of our amenity spaces to better align with what our consumers are going to want in the go forward, and how are we approaching our unit mixes based on that as well?
All right, hey guys, I'm going to jump in here. It's 11 o'clock and we have about 400 people online. And I just want to let people know, if they do need the continuing ed, please make a note in the chat box on the right-hand side that you're signing out. And guys, I want to see if you're up for staying online for an extra 5-10 minutes to answer any questions that were in the chat box. Are you guys up for doing that?
Yeah.
Yes.
Sure.
Okay, and then
Sure.
just real quick, I'm going to just run through a couple quick slides as a reminder. This webinar, as well as other webinars, you can find on our rejournals.com video replay website. We do have a few additional webinars coming up. This is a national webinar that we are hosting on May 13th at 10 a.m. And then we also have a number of Minnesota continuing educational opportunity webinars coming up. One on May 18th, the 21st, the 26th, as well as some additional ones moving forward. So you can find all of our webinars and stuff online at rejournals.com, or look out for one of our many emails and stuff that we send out to everybody. So thanks again. And if you need to log off, please make sure you log off and say a note on the side. Otherwise, if you guys want to continue the conversation, my question to Keith and Ted is, you said the market, when is the next deal going to happen? When do you really think the next big, called $50 million plus trade is going to happen in the market?
Well, we have a $30 and $40 million deal under contract, so I hope those happen soon. But I think it could be a while. I mean, I just, again, we're just, because there's nothing really. Now, the one thing is, there could be some off-market opportunities that get done, but it's again, it's probably going to be a slow next 3-4 months for new product get out there and transacting. There's again, we've got a couple pending deals that hopefully will clear. But again, I think it's going to be a relatively slow, compared to past years. And again, we had record years the last 3 years, hitting like $2 billion a year. So this is unfortunately going to go back to probably sale volume we saw, back in the mid 2000s, unfortunately.
Yeah, I'd agree. I think quarters 3 and 4 will be very light in terms of trade volume. Like he said, maybe there's some off-market stuff that gets done where there's reasons behind or developer needing to get out of a deal, and you can find the right buyer at the right time. But it's really touch and go in terms of formally bringing out listings. I think that's still a week-to-week conversation with clients.
Question I guess I have for Chris or and Brent too, but just again, any downturn, there should be where are the great opportunities in this this I hate to say this pandemic. There's a good opportunity that comes out of that. It's hard to conceptualize that, but again, where do you see the opportunities right now?
Well, we've been George has been in business for 40 years, and some of the best opportunities we've found have been through periods like this over the last 40 years. So as we look out the next 12 to 24 months, I think some of the deals that we're working on will be great opportunities because of potentially lower construction pricing, low cost long-term debt. We're a long-term holder. We're a long-term owner. So as we look through this, there may be a tough year to 2 years or 3 years. But if we're going to hold that asset for 10 plus years, I think if we can get our basis down a bit with construction pricing coming down, maybe get land for a bit less because land prices come down and finance it at 3.5%. There's going to be some pretty good opportunities for us to pursue. We do a lot of HUD insured financing. That's 40-year debt, non-recourse debt. And I think we'll look at some more longer term paths to closing. HUD takes 12 months to get to a close, but we're not in a huge rush to close certain deals. And right now, a HUD 221D4 is in the low threes plus MIP. So you're at 330 all in for your 40-year rate. There's going to be some good opportunities, but we're being, as I mentioned, cautious about which projects we're moving forward right now and which ones we're putting on hold until 2021. But I think in general, the Midwest, the Twin Cities being very affordable, is going to continue to provide attractive opportunities for us long term.
Yeah, and I think we've really struggled with over the last few years is really just the math of new projects and being as Chris said, a long-term holder. The math is different than a merchant builder that is working on a spread from return on cost to cap rate, and that spread has existed. So a lot of projects have been built, but the yields have been so low of late. If you are a long-term holder, for us, I think to see opportunities, some of that math needs to change. And it needs to be on costs. And as Chris said, land, construction, those are constructions, obviously, that's 70 to 75% of our typical pro forma cost is construction. So, that's a big needle mover if that goes around. And then on the other end, on revenue, what does this mean for what rents are going to be in a year or two? You see newspaper articles that say that the urban core is that nobody's going to come back. I don't necessarily believe that, but I also think that some of our best performing lease ups over the last few years have been first ring suburban projects that have an urban feel and walkable amenities. So in this new environment where more people are going to work from home, that I think that trend is definitely going to continue and accelerate. That suburban type projects with urban style amenities are going to be great, and generally they're easier and cheaper to build.
All right. Any final? How about we do this? Why don't we do a quick roundtable, all four of you? Final takeaways. What's your outlook of the apartment market for the rest of 2020?
I can start. I believe the multifamily housing industry long term is going to continue to perform very strong, and I think specifically in our market, our region, we will gain ground on some other regions in the balance of the country during this period, as a result of I think the affordability we have, and as a result of the strong peer-to-peer interaction that exists here. As we look to our other markets, Denver and markets we're not in, I don't think some of that peer-to-peer interaction occurs at the same level that occurs here. And ultimately what that does is allow us to provide better service to our customers and work together to enact better policy. And I think it's a great market to be in for the long term. For 2020, certainly there's going to be a slowdown of development, but I think there will be, in the second half of the year, a lot of development deals that get done. I think it's critical that we continue to find ways to get development deals done because we have a huge shortage of housing, huge, especially on the affordable side. So it is critical that we take advantage of low interest rates and hopefully some reductions in construction pricing over the next 3 to 6 months to close on as much as we can in the second half of this year. And hopefully that can be achieved, but certainly it's going to be a slowdown compared to what we projected.
I would just say, obviously these are challenging times. There's no, when you have unemployment rate the way it is, there's just no, end of sight of where this, vaccine and antiviral. But at the same time, I feel fortunate, and I think on the panel here, market rate housing is a good place to be. Especially compared to other food groups. Even senior housing. Who would have thought? How challenging that is right now. But market rate housing feels very good to me long term. And also, I think Minneapolis, just to give them the diversity, all the Fortune 500 companies. I mean, how many are companies, the 3Ms, the Cargills, and Target? All these companies are, a lot of them are doing, pretty well. United Healthcare Group, et cetera. So I think Minneapolis is going to be positioned to weather this storm better than a lot of their markets. So that's kind of my closing thought.
Yeah, and I think I'd echo what Keith said. I think so much of it, for us, our exposure is really in top of market, Class A, relatively new build deals, and in any given month, 50 to 75% of the prospects that are walking through our door are new to the Twin Cities. They're moving here for jobs, and I think one thing that is great about Minneapolis is that there are all those companies that are hopefully going to continue bringing people in. I would be really concerned if and what we saw in 2009 and 10 was not dire straits, but when hiring really slowed down and new people were not moving to the Twin Cities, that's when our traffic was way down. So I think this diverse economy, I do think we're going to probably have a lower occupancy level, especially at the top of the market, than we did the last few years. But the diverse economy and companies that are still doing well will hopefully keep things shored up.
I go back to the asset classes and how multifamily is insulated from a lot of the long-term and short-term impacts. I mean, you see the hospitality has fallen off a cliff, and that's not going to be permanent, but it's certainly going to have some duration to it. And then just the way that retail and office are being totally re-engineered in terms of how investors look at either of those product types. And industrial is doing very well too, but I just think housing is going to be one of the quickest to bounce back, and will have more upside than most of their product types.
All right, excellent. Great information, everyone. And once again, as a reminder, if you have not signed out yet, we're going to keep the chat part open for another 5 minutes. So please add your name to the chat component, just as so we can make sure that we have you signed out for today. Thank you, gentlemen. Enjoy your days.
Thanks, guys.
Thanks, everyone.
Thanks, everybody.
Hey, Everett. Hey, have you been over to Wilder Terrace yet or not?
Yeah.
Okay.
I just went to Menards to get a light for the kitchen.
Yeah.
I fixed the porch light.
Okay.
And I need to get a new kitchen.
Okay. Rich. Oh, jeez. Is he? Okay. All right. Well, I was on a conference call, and unfortunately I was not able to give them a heads up. So were they around or any issues or not? Okay. We were okay. Okay. All right. Perfect. Yeah. So what do we want to do there? Just scout it out, or what do we want to do? Yeah. Okay. Okay.